Welcome back to the lecture number 12. At the end of this lecture 12, you would be able to complete the financial transaction for a first period since inception of the company. We are assuming a financial period of 3 months from April to June. And how in 3 months the P&L and balance sheet is built up from the financial transactions by using double entry system. Now let us start. Now this is the entry what we have seen of P&L from April to 31st of May, balance sheet of May 31st. Let us look at it, very important point. This is profit and loss from April to May, whereas balance sheet as on May. That means, so balance sheet is always as on a particular date and profit and loss for a period. Now, let us proceed with the transactions. During the month of June, what has happened? The entity sold finished goods worth of 20 lakhs for 25 lakhs on 60 days credit basis. The first finished goods has to move out from the store. Since it is to move out from the store, the first entry would be credit balance sheet asset, current assets, finished goods. Very simple. Now, this is credit on the asset side, so it's minus 20 is marked in red. Now, the second entry after this 20 is there, so this amount would be 9. 29 was a debit, 20 credit, so 9 would be the balance of the finished goods after this transactions. So the second entry would be, as we know, will come here because it will be the second entry would be debit. Debit, if you look at it, so second entry would be in that case, the second entry would be in that case. Now the moment it comes, the total is getting changed. Now total is becoming 31. Now second entry would be debit P&L expenses decrease in finished goods. So debit P&L expenses decrease in finished goods. Now it is 20. Now what has happened? Since the finished goods is moving out of inventory, so that is cost is booked. That's why it is in black. That's a debit entry. Now the net amount increase or decrease in finished goods would be 9. So what we'll have? We have 9. So here you have seen when the finished goods moves out of the stock, how the accounting entries are prepared. Now this is the transactions what has happened. Now during the month of June, the entity sold finished goods of 20 lakhs for 25 lakhs. Now the sale is happening. The first transaction is how it is moved from the store. Now sale is happening. 160 days credit. So first entry would be the debit balance sheet since it is sales on deferred basis. So it's an inflow first entry, inflow but deferred. That's why the entry would be the debit balance sheet asset, current assets receivable. Debit balance sheet, current assets receivable is 25 lakhs. Now what would be the second entry? If you can recollect, that second entry would be definitely credit. Is this now if you see now the current assets balance has changed. The current assets balance has become 56. Now the second entry would be credit. Now credit P&L income sales 25. Why? Because it's a permanent inflow. Since it's a permanent inflow, that's why it is credit P&L income sales is 25 lakhs. Now let us look at it. When the sales is happening on credit basis, then also it is booked as an income. When the sales is happening in the form of a cash, then also it will be booked as an income. This is called accrual method of accounting. What is an accrual method of accounting? When an entity recognizes an income, in that case, whether it receives it or not, then it will be booked as an income. So in this case, the sales is happening on credit. It is not receiving today. It will receive after 60 days basis. Still, it will be booked as an income. Now let us look at it. What is the income? Income is 25. If we see there is no other transactions and we are closing the accounts, then let us look at it how the profit would be transferred. So this is 25 is the income. And on the expenses side, what we have 36, 41, 41 minus 21, correct? So if you look at it, 41 minus 21 is how much? It is 20. So 5 is the profit. So that means debit P&L expenses amount transferred from to balance sheet. So whatever the profit is there, this profit is transferred from P&L to balance sheet. And this amount will come under the head called retained earning. So it is debit transferred to balance sheet 5. Why it is debit? Because credit is 25. Debit we have got 20. So remaining amount, which is the surplus profit, is being moving out from here and it is going to the part. So that is part. So in that case, the retained earning, it will go to the retained earning. So retained earning would be 5. So what we are saying, if there is no other transactions and account has been closed, the profit, that is surplus of income over expenses, would be transferred from P&L to balance sheet. And how we transfer it? Debit P&L expenses side, we are transferring the profit to the balance sheet, and this profit will come in the retained earning. Now let us check what is the total of the income. Income 25, expenses 25. So the surplus is being transferred. Now asset, if we look at it, the asset is 50 plus 5 and 56, 111. On the liability side, how much is there? 100, 5 and 6, 111. So this is the double entry principles. So if it's a double entry system, since debit and credit are equal, at the end of the financial year, profit would be transferred to the balance sheet and balance sheet asset and liability would be equal. Now what has happened? Let us not close the account. Now let us do a couple of other transactions and then close the account. During the month of June, the entity purchases raw material worth of 40 lakhs by taking a 2-year loan of rupees 10 lakhs and a cash credit facility. Cash credit means a running account facility from a bank of 30 lakhs. First entry, that the entity is taking a 2-year loan of rupees 10 lakhs. So if the entity is taking 2-year loan of 10 lakhs, it means it's an inflow immediate. So entry would be the debit balance sheet asset bank. So that is an 10 is inflow has happened. Previously it was 10, now 10 inflow has happened. So the closing balance is 20. The moment the closing balance is 20. Now what would be the other entry? Now the second entry would be the credit balance sheet liability, non-current liability loan. So it is credit balance sheet liability, non-current liability. Why non-current liability? This loan would be paid after 1 year. So that is 10. Now let us look at the entity has been sanctioned a CC limit, and from this limit rupees 30 lakhs can be borrowed. So again it's an inflow of fund. That means now again 30 lakhs has come. So from CC 30 lakhs has come. The company has borrowed in the form of a cash credit. It's a running account. So this 30 is an inflow immediate in the bank. So it has become 50. Now what would be the second entry of this? Second entry would be credit balance sheet. Now what would be the second entry? The second entry would be the credit balance sheet liability creditor. No, it will not be the debit. Let me change it. It is basically the second entry would be in this case. The second entry in this case would be the, now if I look at it, second entry in this case would be credit balance sheet. Now in this case, second entry would be the credit, this one, the credit balance sheet, current liability cash credit. So the second entry would be the credit balance sheet, current liability, cash credit. Because first entry of this is a debit has come. The second entry would be the credit balance sheet, liability, this part. Cash credit is 30. Now the entity purchases raw material. If the entity is purchasing raw material of 40 lakhs, so for this there's an outflow of fund, immediate. So if it's an outflow of fund immediate, first entry would be the credit balance sheet, asset, credit balance sheet asset, current assets bank of 40. Since credit on the asset sides, we are showing it minus 40. Now closing balance of the bank would be 10. Is it clear? And what would be the second entry? This is an outflow of fund is happening, and on account of outflow, the raw material is coming. So the second entry would be the debit balance sheet asset, current assets, raw material 40. Now, what has happened? Now you see the current assets will also undergo a change. Current assets would be, in that case, inventory would be 61, 40 plus 12 plus 9, and current assets would be, in that case, the 96. So here I have shown a transactions where a company is buying raw material by taking a long-term loan as well as a cash credit. Now, the entity has to account for wear and tear of fixed assets. When the fixed assets is used for productions, it is going wear and tear. For that matter, every fixed assets or intangible assets will go wear and tear. Now, for the case of the fixed assets, which is a tangible asset, which I can touch, the wear and tear is calculated by an entry called depreciation. So if the depreciation, how we calculate depreciation? Depreciation is calculated based on certain principles. These principles can be is depicted in the Company Act. In the case of the company, in the case of the IT Act, for IT calculations, income tax calculation, depreciation is prescribed. So we use a method, and by using the method, then we calculate the depreciation. Let us assume that the depreciation for this period, that means from 1st April till 30th June, is rupees 1 lakh. What does it mean? Originally, the fixed assets was 50 lakhs, and during this period, wear and tear has happened, and the value of the fixed assets will become 49 lakhs. So the following entry will be passed. So first of all, we pass an entry called accumulated depreciation. Accumulated depreciation, the word accumulated has a meaning. You will get the meaning when we go to the next period of the balance sheet. This is the first year, that's why we don't get the correct meaning. But the terminology we use for balance sheet is called accumulated depreciation. It means that since inception till this date, how much of depreciation is been accumulated on account of the fixed assets. Now here, since this is the first year, so that's why for this period, 1 is been done. So my net fixed assets or net plant and machinery is 49. So what is the net plant and machinery? Gross value is this 50. 1 is the amount, is the depreciation till since inception till date. What is the total amount of depreciation? So from the gross value, if you deduct the depreciation, that is the net value. So net value is 49. So the first entry will be credit balance sheet fixed assets, plant and machinery. Accumulated depreciation is 1 lakh. So what will be the second entry? Debit P&L expenses depreciation is 1. Please listen, there's a difference. In the balance sheet, we get something called accumulated depreciation. In the P&L, we get something called depreciation. Accumulated depreciation means since inception till date. In the P&L, depreciation is only for this period. Now, what we'll do, the entity also pays an EMI of the loan of 1 lakh. EMI means equated monthly installment. Every EMI has got 2 components. One is the interest component, one is the principal component. Suppose the 1 lakh EMI which the company is paying to the bank, the interest amount is 60,000 and the principal amount is 40. Now please remember that first we'll calculate the interest. First entry would be the outflow, because 1 lakh the company is paying to the bank as an EMI. So it's an outflow, immediate. So the first entry would be the credit balance sheet. So what would be the first entry? The credit balance sheet. The credit balance sheet asset bank 1. So if you look at it, now let us look at it. Credit balance sheet asset 1. So here, please pay attention here. Now the balance sheet would become 9 because 10 was the debit balance. 1 is an outflow, that's why credit. So the balance is 9. Now this, what would be the second entry? The second entry, if you look at it, so now what has happened, instead of 96, it will become 95. The second entry, interest. Interest is a permanent outflow. So the debit P&L expenses interest. So what do you say? Debit P&L expenses interest is 0.60. Please pay attention. When an EMI component is there, 2 components, principal and interest. When the interest is there, first is an outflow, credit balance sheet asset bank, but the debit second entry would be the P&L. Now, in the case of the principal amount, the second entry would be debit balance sheet liability term loan. So in this case, the second entry for the principal amount would be balance sheet, equity and liability, debit term loan. So term loan would be the debit part. So EMI consists of interest and principal. Interest would be going towards P&L, and the principal amount will go towards the liability side, because principal means from the principal it is getting paid. Since the liability is coming in debit, that's why minus 40. So 10 minus 40, closing balance is 9.60. Assuming no other transactions, how it is happening. Now we are closing the P&L. Now here, what we have done, we have charged depreciation, we have repaid the loan, we have paid the interest, we have also purchased the raw material. Now if you have to close it, so what will happen? Same principle. Now this is 25 and the remaining amount will come here. So it is basically transferred to retained earning is 3.40. How we have arrived at 25 minus this, that is 25, and this one is 36, 41 minus 21 is how much? 41 minus 21 is 20, then 121.60, 21.60, and 3.4 is the basically the 25. So my P&L asset income and expenses is tallied. This 3.40 will definitely come from where? This 3.40 will come from here to the retained earning. It is coming in retained earning of 3.40. Now look at the total. Now asset should be equal to liability. Now let us look at the asset total. 49 plus 5, 54. 54 plus 95 is 149. Liability side 100 plus 3.40, 103.40. 103.40 plus what is that? 9.60. 103.40 plus 9.60, 113. 113 plus 36 is the 149. So asset equal to liability. So as on 30th June, what we have done for the first period, we have created the P&L and we have created the balance sheet. So we started with a promise that even if you don't know anything in accounting, we shall build up concepts which will help you to become expert in accounting and finance. And we started with the layman's language, with financial transactions, how the financial transaction will be converted into accounting entries by double entry system, and how a business entity carries out different types of financial transactions and how the same is converted into accounting entries and captured in P&L and balance sheet. And we have captured all financial transactions which can happen to a business entity for a particular period. And we have also shown it to you that how P&L and balance sheet is prepared. In the next sessions, we will take another 3 months for another financial period and see that for the new financial period, how P&L and balance sheet is being built up. Till then, thank you very much for listening to this video.